Hey, Ben Smith with Cove Financial Planning. Let's talk about market volatility. A lot of stuff going on in the news with the markets, coronavirus. I want to talk through the what, the why, and the how. What's going on in the markets, number one. Number two, why is it happening? What's driving all the volatility? And more importantly, number three, how can you respond, right? How can you be smart about reacting or not reacting to all this volatility? If you've talked to me recently, you're sick of me saying, stay the course, this too shall pass. So that's the underlying theme here. But to start, really, what's going on? So since 0809, we were in a historical bull run, a historical 11-year upswing in stock market history. It seems like we're now reversing that trend. So keep in mind that these cycles tend to last 8 years or so. I said, we're 11 years into the last upswing. So it's normal, right? It would be weird if this didn't happen over the next few years. It happened pretty quickly, but it is normal. From a numbers standpoint, we're now 15% lower from market highs. So last month in February, U.S. markets reached a high. We're now 15% off of that. A lot of people say if there's a 20% differential, that's a bear market in a potential recession. So we're close to that. We're not quite there. We're very close to it. But keep in mind, the where the market is today is exactly where it was less than a year ago in May. And people then were saying, hey, I think we've reached a high. What should I do? So it's all, to put in perspective, it's all relative. So we're close to where we are a year ago. So that's sort of what's going on. Why is all this happening? What's driving all this? Obviously, number one, coronavirus, spreading fear of the impact to the economy. We're seeing schools, universities, employers, different companies saying, hey, stay home. We're going to cancel certain events and conferences and things like that. People are concerned about productivity as a result of all that. U.S. companies like Apple, Walmart, Procter & Gamble, to name a few, have already said their earnings forecasts are lower. So they're basically saying, hey, this is impacting our numbers. That obviously impacts stock price. So that's the first thing, coronavirus. Number two is oil prices. We have Saudi Arabia and Russia in a price war. Saudi Arabia has said we're going to reduce prices and we're going to increase production. So oil rates or prices rather are as low as they've been in several years. So that impacts energy companies. It impacts financial services companies. Again, comes back to earnings and the impact of the global economy. Number three, you may have read in the news, the Federal Reserve, the Fed, reducing interest rates. So remember, the Fed has a couple levers they can pull to boost the economy. Number one is changing interest rates. So they've lowered interest rates just last week, and it was a surprise. It came as a surprise. It wasn't planned. We saw the Bank of England do the same thing just a week after. We saw a little uptick in the markets, but not as much as they probably anticipated. But that is in the interest of stimulating the economy, right? Make money cheaper so that I go to the store, invest in the stock market, and buy things. And so in addition to that, the government has also said that they are working on a financial stimulus package. Again, in the interest of increasing spending and boosting the economy. So we'll see what that looks like. Markets may respond well to that. So that's sort of the why behind it so far. Most importantly, how can you respond? What can you do amidst all this concern and uncertainty? Number one, most importantly, stay the course, right? This too shall pass. If you're invested in a diversified portfolio for long-term goals, put the blinders on. Okay, this will pass. You'll be happy that you did. A lot of people didn't do that in 2008, and they sold down here, and then they missed the upswing in the market. So don't let that happen to you as it relates to your long-term goals. Also remember, this is an interesting stat I read. Since 1926, so here's today, 1926, the S&P 500, the U.S. stock market, has returned a positive number 73% of each calendar year. So in other words, 3 out of 4 years going back to the 1920s, the U.S. stock market has ended the year up. So I like those odds. History tends to repeat itself. There's no guarantee it will, but remember, don't let short-term volatility and concern drive long-term decisions. To that end, if you haven't reviewed your portfolio in a few years, now is a good time to do it. Make sure it aligns with your risk tolerance level, your time horizon, your long-term goals. Make sure it's optimized in that way. If you have taxable accounts, so money outside of IRAs, 401ks, pensions, 403bs, you can reduce your tax bill now that the market has dropped. So it's called tax loss harvesting. And all it means is you have a diversified portfolio. You have some positions at a gain, some at a loss. You can sell your investments at a loss to offset the taxes you pay on the gains. So you could save thousands of dollars doing that. Quick exercise. Again, that's for taxable accounts outside of retirement-focused money. The next thing is maintain a cash reserve, right? Look back at your financial plan. Make sure your cash reserve is sufficient. The last thing you want is to be pulling money out in a down market unless you need to, if you're in retirement. And then finally, if you're a homeowner, now's a good time to look at refinancing your mortgage. So yeah, historically low interest rates that we're seeing now, mortgage rates often follow that. So a really good time to at least think about it, consider it, get some quotes. You want to make sure you'll own the home to get the payback on the cost of refinancing. But same goes for folks looking for a mortgage, buying a new home. Not a bad time to do it from an interest rate perspective. If you want to talk about your plan, feel free to reach out if you have questions. My email is ben@coveplanning.com.